Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Our guest today, three of the best in the business. Rich Powers is the head of ETF and Index Product Management at Vanguard. Jay Jacobs, from head of research and strategy at Global X, and my old friend Nicholas Coles from Data Trek joining us as well. Rich, we've got an anniversary, 20th anniversary of the Vanguard Total Stock Market ETF. It was Vanguard's first ETF launched 20 years ago today, and what I remember about it, and I was here right at this very point when it started trading, was the low cost of it, number one. We had index funds before Vanguard had them, but it really helped popularize that VTI, the whole concept of index and ETF investing.
Well, that's right, Bob. If you think about indexing has been core to the Vanguard DNA since our founding in the mid-1970s, but our entrance into the ETF marketplace, what that did for the marketplace, not only for our clients, but also for clients of ETFs at large, is lower the cost of investing for all of those who are considering ETFs. You can see that today in the cash flows, where the vast majority of cash flows in ETFs go to ETFs at single basis points expense ratios, and so kind of democratized low-cost investing for ETFs. Certainly, the idea of better tracking of our benchmarks relative to our indexes was something that we brought to the marketplace. There were products that were in the ETF wrapper that were not tracking their benchmarks as well, and we brought our sophisticated approach there. And then lastly, this idea of having to trade ETFs to actually tap into their utility, we've been able to kind of disavow that as more and more investors are using ETFs as a strategic asset allocation, and I think we brought that concept to the fore.
And I want to make people sometimes think this is a big cap fund, but it isn't. It's market cap weighted, but it's the total investing universe. You have small caps in it. You might even have micro caps in it, right? I think that's the key point here. It's market cap weighted, but it's across the entire spectrum, and it's neutral, right? There's no sector overweights or anything like that, right, Rich?
That's exactly right, Bob. The exposure offered by Total Stock Market is from the largest companies in the U.S. to the smallest companies, and so you're getting a market cap weighted exposure to that market, inclusive of all the different sectors that are there, and they're simply allocated based upon their weight in the overall equity markets.
Yeah, this was one of course, Vanguard's founder Jack Bogle's favorite investments that's out there, and it was along with total bond market as well. Maybe we can talk about that a little later. You've also got a new ultra short bond ETF that you just launched 6 weeks ago. I'm amazed at how much money it's gotten. 500 million in assets, an ultra short bond ETF. What has this got all of a sudden that's made it so popular?
We're really excited about this, Bob. This is something that we've been looking at for some time, and we launched a mutual fund version of this product more than 5 years ago. But our investors were increasingly telling us they'd love to have this strategy within the ETF wrapper. And so this is an active ETF. This is our first active fixed income ETF. And I think it's a product that's benefiting from the times we find ourselves in. Certainly not why we launched it. We think this has enduring long-term investment merit. But if you think about the current interest rate environment and where money market yields are relative to, say, short-term bond yields, this product kind of falls in nicely between the sweet spot of those two, where you have a 1-year duration, around a 50 basis point yield today, given current rates, and you're getting for your 6-month to 18-month investment time horizon. This type of product could be really suitable to pick up that yield when yield is so hard to find today.
Yeah, 1 year is relatively safe. It's not risk-free for sure, but it's certainly that's a much better yield than sitting in a money market fund right now. Rich, let me bring you in here. Excuse me, Jay. Let me bring you in. You run some of the largest thematic tech ETFs. I constantly put up Global X ETFs around cloud computing and lithium batteries and robotics and fintech. We have been noting, I've been covering this for a month now, 15, 20%, 25% declines or more in some of these thematic tech ETFs, including yours. And yet you, in our discussion at the end of last week, you made it very clear that the outflows have been very modest, 0 to 5%, you were saying. How do you explain price declines of 25% or even more in some cases, but very, very modest outflows? What's going on?
Well, I think the first thing to look at is just the trajectory of this performance. So we've seen phenomenal performance in pretty much any theme related to digitalization, video games and esports, e-commerce, cloud computing, these themes really thrived during the stay-at-home economy, saw really strong 2020s, and we're seeing a little bit of a pullback in the last few months as people get ready for reopening. So the pullback is real, but it is relatively small in the grand context of what we've seen over the last 12 or so months. Beyond that, though, I think the bigger... Yes, Bob?
Go ahead. Go ahead.
No, I think beyond that is the people who are owning the funds and really their behavior. So I think there's a little bit of a misconception in who's buying into these ETFs. Sometimes the market just thinks, it must just be retail buying a cloud computing ETF. But really, it's much more focused on financial advisors and even institutions that are buying these ETFs. Last year, about half of our inflows came from financial intermediaries. So that's financial advisors, registered investment advisors, brokers. And 15% came from institutions. So these are serious investors sticking to long-term strategies and are holding these ETFs for the long term. They are not going to be affected by daily or weekly trends.
That's very interesting. So only about a third of your holders are retail, what we would consider weekends or people who might be short-term, more momentum investors. 2/3 are longer term. Nick, I wonder if you could comment on that. You've been very eloquently writing for a long term about thematic tech. You did a piece last week about the J curve and investing in this kind of technology. I wonder if you could explain that, because the concept is very clear to me that longer-term investors look at these companies with the understanding that they're probably going to lose money in the first few years. So they're not expecting anything for the first, say, 3 years, but they are expecting something for the 4 through 10 years. And that J curve sort of dominates a lot of thinking for longer-term tech investors.
Yeah, Bob, that's right. And I think Jay set it up really well. We've had this huge raft of disruption come through the system in the last 12 months because of the pandemic, and a lot of exciting companies start to get built. But we also know that they're not all going to be winners. And so sophisticated investors understand that the first couple of years investing in a big disruptive trend, you might see some choppiness in years 1, 2, and 3 because not all of those things are going to be winners. But as we get into years 4 through 10, the winners do begin to pay off. Think about it as buying every e-commerce company in 2000. A lot of them went bust, but you still outperformed massively because you owned Amazon, and over time Amazon won everything. So the ETF structure really is an ideal way to play these themes because you're not betting on 1 or 2 companies. You're looking at the whole theme and saying, I want to be there, and I know the winners are somewhere in this list that I'm going to own them when they win.
Yeah. I wonder... Rich, if you could comment on this from Vanguard's point of view. We cover this here at CNBC because my job is to cover the ups and downs of the stock market on a daily basis. But, Vanguard, I wonder what your viewpoint of all of this thematic tech investing is. Vanguard doesn't offer this kind of thematic tech idea. It offers broad arrays of products, but a lot of this strikes me as still momentum-oriented in a way. Can you give us your or Vanguard's perspective on all of this sort of frenetic trading or buying in and out of thematic tech?
Sure. I think we all know that lots of trading usually ends up in a sad way for investors. That actively trading is a really challenging way to make profits. I think one of the challenges that investors, be it individuals or financial advisors, will encounter in thinking about the thematic space is what actually constitutes thematics, right? Is it ESG? Is it tech? Is it clean water? Is it something else? So I think there's some open questions there from a definitional standpoint. But maybe the broader question I'd be asking is what problem is trying to be solved? If you look at the success of ETFs of the last 20 or so years, it's largely been on the backs of indexing as a concept, right? That investors have come to appreciate the virtues of low-cost, diversified approach to investing, and really simplifying their lives. Going down this path of investing in more focused areas, certainly there's benefits to that, but it usually comes at a higher cost. And it also usually comes at a cost of time. If you're going to do it right, you need to invest more time.
Yeah. I wonder, of course, Jack Bogle will be appalled at all this discussion about buying into and out of thematic tech ETFs, but that's what we do these days. I wonder, Jay and Nick, if you could address the role of higher rates and inflation on these companies. Nick, you're the expert here. I don't want to go into a tutorial on the discounted cash flow model, but can you explain why when rates rise, that is a problem for stocks, but particularly it's a problem for companies that don't have any profits right now? Why is that such an issue? Because these all hit their highs in February when rates started going up and have had a problem ever since then.
Yeah, it's a fantastic point. And the simple explanation, but still very accurate, is if you're betting on a company to make a whole lot of money in 4, 5, 6, 10 years' time, then you're at basically the behest of what interest rates are, because if interest rates go up, those dollars in the future are simply worth less today. And investors are keenly aware of this dynamic, and that's why you see tech kind of trade with interest rates. At the same time, you are still betting on a disruptive theme, and you're betting that it will eventually be deeply profitable. So I always tell people, don't worry too much about rates if you understand and believe in the core technologies, because those will win out. But it is another reason why you're going to have to eat some volatility in the near term, particularly in the current part of the market cycle.
Yeah, you know, Jay, Nick's got a great point here. We love talking about cloud stocks, for example, about Fastly or JFrog or Snowflake or PagerDuty or any of them. But by and large, they don't make any money right now, and they're not. Talk about a J curve, though, they're not expected to make any money for the next several years. There's a sort of hope down the road that they'll do that J curve that people are talking about. You feel your investors are certainly cognizant of all that, being longer-term investors?
Yeah, I mean, this is a key tenet of thematic investing, is that when you have a huge potential market you're trying to disrupt, you want to put every dollar available into disrupting that market. So if you're a small cloud provider, the absolute wrong thing to do is be giving dividends back to investors or buying back your stock. You want to take every dollar coming in, reinvest it in making your technology better, growing your sales force, buying a competitor, really trying to firm up your position within a very fast-growing market and try to dominate it. That's what we've seen with the likes of Apple. That's what we've seen, with the likes of Google, Amazon. A lot of these really big tech companies have really not focused so much on profitability in the last few years, but have really focused on continuing to maintain high growth. So if you look at some of these themes like cloud computing, or even earlier themes like lithium and battery technology that's going into electric vehicles, they're absolutely not in the part of the cycle where they're thinking about earnings. They're thinking about growth, growth, growth. Yeah.
Yeah, but as Nick implied there, you've got to essentially go through a lot of clunkers to find a handful of winners, which is what, you know, the JV people do, the joint venture crowds are trying to figure out, you know, if you're investing in a whole bunch of different companies, how many of them are actually going to be successful. Jay or Nick, I wonder if you can explain outflows. Last week, the last couple of weeks have been a problem for me because people seem to be very confused about what happens with outflows and who actually controls outflows and the differences. So maybe, Jay, you can explain how that happens, how you have price declines but no outflow. So what happens when there is an outflow? Do you sell the underlying shares? Is this determined by, does the market maker do that, or do you actually do that? People seem confused about outflows. Explain what happens in that process.
Yeah, sure, absolutely. So if effectively there's more people selling the fund than buying the fund, you have an imbalance, and ultimately there's going to be redemptions out of that ETF. Now, for the vast ETFs, when there's a redemption, that means the ETF issuer like Global X or Vanguard or whomever is going to deliver the underlying shares of the companies held by the ETF to a market maker in exchange for redeeming the shares of the ETF. Then it's really up to that market maker to do what they want with those underlying shares. So if they've just redeemed a basket of tech stocks, they could sell them, they could hold them, they can lend them, they can do a lot of different things with it. But there's an intermediary between redemptions and actual selling activity in the market on those underlying companies. What I would also further distinguish is that funds can go down in price without seeing outflows. So a fund is really just a reflection of the average, value of the stocks being held by that fund. If those stocks fall 10%, but all the holders of that ETF are still perfectly fine holding the ETF, you're not necessarily going to see any redemptions. The fund might be down in value, but people are still hanging on in there. That's what we're seeing in thematic tech right now. Not a lot of redemptions, but the price of some of the shares is down.
So it's the question is that process by which you decide to essentially create the redemption process, where you would surrender shares of the stocks underlying it to the market maker. Is there some trigger point? You generically said, well, there's more people who want to sell the fund than want to buy it, that would trigger outflows. But is there some legal obligation or something like that where you're required to actually do that to, for whatever reasons?
Well, it's ultimately up to the authorized participants, who are often the market makers, if they want to redeem the shares. So an ETF should always be open to redeeming shares, and it's the market makers that are going to say, we have enough shares to redeem. We'd like the underlying companies in there. So it's not really up to the ETF issuer. It's up to the market makers and what they want to hold.
Yeah. So the shares, it's the market maker ultimately will decide what to do, whether they're actually reducing the share count or not. Is that right? I mean, is that how it works?
Yeah, effectively, yes.
Yeah. Okay. A little bit of market internals there, folks, but I can't tell you how many people messaged me last week and wanted to know a little bit about that. Jay, you're big on, just one more thing. I know I'm hitting on you a lot here, but I want to go back to this thematic idea here. Infrastructure is very hot right now. The negotiations are heating up. You've got one of those infrastructure thematic ETFs, PAVE, right now, and it went from, what, 100 million last year? Now, is this right, $3.5 billion? Are people looking to play the American Jobs Plan here right now, or what are we doing?
That's correct. I mean, this is a fund that we launched actually during the previous election cycle, when it was Hillary Clinton versus Donald Trump. Not a lot of consensus between those two on what they wanted to do politically, but one area where we saw consensus was in infrastructure development. Fast forward 4 years later, it's very much kind of ripe for disruption, if you will, with an economy that's still, below kind of prime GDP. We're seeing a lot of talk about the American Jobs Plan. Even if Biden doesn't get his way, Republicans have a counter that still includes hundreds of billions of dollars for infrastructure. So I think investors are very excited about the prospects of probably the largest infrastructure bill we've ever had in the United States, and a fund that's really designed to own the winners of that type of bill: construction engineering companies, commodities, transportation companies, and heavy machinery companies that are going to be building that infrastructure.
Rich, while I've got you here, you're one of the big ETF watchers here. What are you seeing in the ETF business right now? What are clients interested in doing it? I know there's been very notable inflows into plain vanilla, what we call plain vanilla, indexed, and that plays right up your alley. Any other observations on what investors are doing right now?
Yeah, Bob, investors continue to focus on broad-based funds. So our total stock market, our total bond market funds are certainly among the best sellers in the industry this year, but also for the last several years. So investors are focused on diversification and low cost. I think the other interesting thing that we're keeping our eye on is the adoption of ETFs by newer investors. So only about 10% of all individual investors without an advisor use ETFs, and we're seeing that number increase on our platform and elsewhere. And then even advisors, we're hearing more and more advisors shift to ETFs. It happens when you have these market events like we had in the last year, where a big sell-off happens and you see a leg up in terms of ETF adoption. It happened in the global financial crisis. It happened in the early 2000s. These types of events tend to be a catalyst for another upward trajectory in terms of ETF adoption across a full range of clients.
And Nick, you're one of the better market watchers that I know out there. Why don't you give me your 30-second, 30,000 view of what we're going to see this summer? We flattened out a little bit on the S&P earnings. They're still raising numbers for the second and third quarter, and it seems to me the conversation with the Federal Reserve about tapering has already begun. The market seems to be happy about at least starting that. Who knows how it'll end? Tell us what you're expecting over the summer for the markets.
Yes, you're right. I mean, the funny thing about this year is that we've seen more earnings revisions than we've seen stock price performance. We've seen 12% upside to earnings expectations this year, only about 10% on the S&P. So multiples are coming down, and you're right. It's going to come down to Q2 and Q3 earnings. The numbers are still too low, it seems to us, for Q2. So we should have another strong earnings season coming up, but that will be kind of the tug of war until then. So expect a couple more weeks of exactly what you've just seen, and then as earnings begin to show themselves through, another leg higher towards the end of the year.
Yeah, I think, and I noticed the VIXs have been flattening out a little bit here. We already see a little bit of the summer doldrums, but I don't think that's necessarily a bad thing to happen. Remember, folks, we're only 2% from an historic high on the S&P, despite a lot of anxiety. It's a pretty remarkable year. Folks, that's it for this week's ETF Edge. My thanks to Rich and Jay and Nick, my old friend there. We've asked Rich to stick around and talk a little bit more about what Vanguard's doing in the ETF space. for the next few minutes, so we appreciate him sticking around. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.